Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is David Barse, founder and CEO of XOUT Capital, to discuss an investment philosophy not based on picking stock winners. David, it's great to have you with us. Welcome to Trade Talks.
Jill, it's nice to be here. Thank you.
And this sounds really interesting. Tell us about the XOUT investment philosophy. What do you seek to identify?
So really, we're flipping the entire investment paradigm on its back, because we're not trying to pick winners, which is what virtually everyone else tries to do. We're simply trying to exclude losers, or those companies that are or likely will be disrupted by technology. And we take broad-based indices as our constituent base from which we exclude.
Why do you think this approach is smarter?
Well, I'm going to posit an insight that it is easier to simply exclude losers than to pick winners. And that's just evidenced in the fact that so many active managers, those managers that are out there trying to pick winners, underperform the market consistently. And so few are able to outperform. And from our perspective, by just excluding the losers or the companies that are being disrupted, the winners take care of themselves. And we've been able to demonstrate substantial outperformance, albeit with a short track record, but even our backward-looking results are very strong just by excluding losers.
And David, how are the XOUT US large cap indexes different than other indexes?
So we start, in our case, with the largest, for the first index, it's XOUT. That's the ticker. We licensed that to Granite Shares, who launched an ETF in October of 2019. We start with the largest 500 US market cap companies. And then we score each of those 500 companies and remove or exclude, or in our parlance, X out, the bottom 250 companies that score the worst with our fundamental metric. That's what's smarter about what we do. We use a rules-based methodology, but the creation of that rule was really smart.
So David, what are your thoughts on the overall equity markets? How does that translate to the work that you're doing on the indexes?
Yeah, look, I'm a long-term optimist and feel very strongly about the best place to be right now is in equities, and quite frankly, in large cap equities. You know, you have all sorts of reasons for that statement. But again, if you're going to be in a broad market index, why do you want to own companies within that index? Because certain of those companies, because the index has to buy everything. Those passive strategies have to buy everything in an index. And so we're I think the only firm out there that approaches the marketplace by just trying to exclude the companies you don't want to own.
So let's work through an example here. So when you talk about disruptive technology, I think what's happening with, let's say, a Tesla as an example relative to traditional automakers like a Ford and a GM. So if I understand it correctly, you wouldn't have some of the older economies, the older stocks, if you will, in this type of index.
Yeah, indeed, our focus is really on what we don't own as opposed to what's owned. So in the example you've selected, Ford and GM are two companies that have been X'd out. They have not scored well. They have not been able to meet the standard that we set for what gets included in. And so that's all I think about. I think about the companies I don't want to own. Ford and GM are good choices. Exxon is another one, because at the beginning of this year, Exxon had a significantly larger market cap and therefore weighting in a broad-based large cap index, for instance, like the S&P 500. By excluding that one security alone, we've been able to create significant alpha with XOUT.
That's so interesting to hear a manager focus on the companies that you don't want within the portfolio. David, it was great speaking with you. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.